Welcome back to Investing Talk Podcast.
Today we're looking at CleanSpark.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. What's really compelling here is that we are watching a company completely change its identity.
In real time.
Exactly. For years, they were just in that Bitcoin miner box. But now, the financials, the infrastructure they're building, it points to something much bigger.
Yeah, a massive digital infrastructure player. And those financials you mentioned, I mean, when I first saw them, my jaw dropped. They are genuinely transformative.
They really are.
Well, let's just start with the top line. For the full fiscal year 2025, revenue growth was 102% year over year.
102%.
Hitting $766.3 million. That's not just, marginal growth. They literally doubled their size in a year.
And you can see that momentum picking up. If you look at just the last quarter, Q4, revenue was $223.7 million.
Wow.
That's up about 150% from the same quarter last year. So the growth rate is actually accelerating, which tells you their investments are really starting to pay off.
But the real story for me isn't just the revenue, it's the swing to actually being profitable. They went from a net loss last year to a net income of around $364 million for the full year. I mean, that's the difference between a risky bet and a maturing company.
And that profit swing, it validates their whole operational model. They aren't just selling more, they are spending less to make every single dollar.
Right.
You look at the profitability margin, specifically the trailing EBITDA margin. It is at an incredible 217.6%.
Wait, 217.6. That number sounds, well, it sounds insane. Are we sure that's not, inflated by a one-off thing like an asset sale?
That is a critical question. And no, it's not a fluke. That margin really shows how well they manage their costs, especially their power costs in the mining business. When they scale up their capacity that fast, the fixed costs get spread out, and the margins just, they go through the roof.
So the core Bitcoin mining business is acting like a printing press.
It's the capital engine, exactly. It's funding the whole new AI strategy.
Okay, so they have this high-margin core business, but building all this infrastructure, that's capital-intensive, usually means a ton of debt. How's their balance sheet looking?
They're acting more like a disciplined utility company, not a spec tech firm. Total assets are now over $3 billion. And when you check their liquidity, the numbers are, they're stellar.
Which is key for any investor to look at.
Absolutely. Their current ratio is really strong at 4.4.
And for our listeners who maybe don't live and breathe finance terms, what does a current ratio of 4.4 actually tell us?
It tells you they've built a financial fortress. It means for every dollar in bills they have due in the next year, they have $4.40 in cash or liquid assets ready to pay for it.
So basically, no short-term funding risk.
Virtually none, even while they're building out these huge projects. And on top of that, their debt to equity is only 0.38. They're not over-leveraged.
That strong foundation is what lets them make this huge strategic shift. This brings us to their competitive moat.
Right.
CleanSpark isn't just about the price of Bitcoin anymore. They've hit this incredible scale, over 50 exahashes per second of their own mining capacity.
Which is an industry-leading position. To put that number in perspective for you, 50 exahashes is 50 quintillion calculations every single second.
Just incredible scale. But the real pivot, the thing we need to focus on, is them moving into AI compute and high-performance computing.
That's the game changer. They're leveraging all that energy expertise and all that infrastructure to host AI.
And a pivot like that needs a serious commitment from the top, right? It's not just flipping a switch.
Not at all. A showed they were serious by hiring Jeffrey Thomas, an industry veteran, as their new senior VP of AI data centers. This is a real focused business unit now.
Let's connect the dots here. Why does their experience in mining give them an edge in AI? It comes down to power, doesn't it?
It's all about power. Bitcoin mining is about optimizing power cost. AI compute is about optimizing power density.
A subtle but important difference.
A huge difference. Your typical data center might draw, say, 10 to 15 kilowatts per rack. These new AI clusters, they can demand 50, 75, even over 100 kilowatts per rack.
So you need massive amounts of consistent low-cost power.
Exactly. And CleanSpark has grown its contracted power capacity by 43%. That is the foundational asset you need to serve AI clients.
And you see this strategy most clearly in their Texas expansion.
Oh, yeah. This tells you exactly where they think their future is. They acquired rights to 271 acres in Austin County and locked in 285 megawatts of power agreements.
285 megawatts.
Yeah.
That's enough to power a small city.
A medium-sized city. And they're pointing all of that at high-performance computing. This is a massive commitment to capture that exploding AI demand.
So they have this dual-use power footprint. This has to be the ultimate diversification play for a long-term investor, right?
That's the moat. That's precisely it. If Bitcoin prices get soft, they can pivot that power over to high-margin AI contracts. If the AI market gets saturated, they can switch it back to mining. It shields them from that pure Bitcoin volatility.
Okay, but this kind of expansion, Texas, new leadership, new infrastructure, it's not cheap. How are they funding all this while keeping that balance sheet so clean?
This is where they've been really clever financially. They just completed a $1.15 billion convertible note offering.
$1 billion war chest. But the terms on that note are the real story, aren't they?
Absolutely crucial. It's a 0% interest note due in 2032.
0%.
Think about that. They've secured over $1 billion of basically interest-free funding for the next 8 years to build out their infrastructure. That is a massive capital advantage over competitors paying high interest rates right now.
That's a huge vote of confidence from the market. But, where there are high expectations, there's always a risk of disappointment. We have to talk about the counterpoints.
We do.
They had 102% growth, $364 million in profit, and they still technically missed expectations.
You're right. We have to address that skepticism. The market's consensus expectations were just extremely high. So the final numbers did come in a little bit below what analysts had penciled in. Earnings per share was $1.12 versus an expected $1.42.
So what does a miss like that tell us when the underlying numbers are so strong?
It tells you this wasn't a structural failure of the business. It was a temporary gap. The market just got a little ahead of itself, It pulled the future value too far forward, too fast. For a long-term holder, the underlying trend is still incredibly bullish.
And speaking of volatility, this stock is still highly sensitive to Bitcoin's price swings. That high beta risk is real.
Absolutely. It acts like a levered play on Bitcoin. When Bitcoin runs, this stock often runs faster. But the reverse is also true. If Bitcoin pulls back, you can see sharp drops, 15% in a day sometimes. You have to be ready for that.
And that billion-dollar note, even if it's interest-free, it's still a liability. Does that introduce new risk?
It does introduce some sensitivity, mainly the risk of dilution down the road if the conversion price gets hit. But you have to put it in context. We go back to that very low debt-to-equity ratio of 0.38. Their use of debt is still very prudent.
So how are they buffering against all these risks long-term?
Two main ways. First, their treasury. They're holding about $1.2 billion worth of Bitcoin. That's a huge asset base, a war chest they can use for flexibility.
Okay.
And second, the strategic move into AI. That's designed specifically to bring in a revenue stream that is much less correlated to the price of Bitcoin. They're building resilience through real diversification.
All right, let's switch gears to the market itself. From a technical perspective, the stock has shown some really strong bullish momentum lately.
It's been a multi-bagger story, for sure. The stock hit new 52-week highs around $22, and the long-term chart shows a massive 3-year gain of nearly 570%. That kind of performance attracts serious capital.
And the technicals back that up.
It's textbook, really. The moving averages are all sloped upwards. The stock is trading above them. It signals a sustained structural uptrend. This isn't just a flash in the pan.
And who's buying? You mentioned serious capital.
The institutions. They own about 76% of the company. We're talking major funds like BlackRock. High institutional ownership like that is a stamp of approval. It tells you the smart money sees the same long-term growth story we've been talking about.
So looking ahead, what's on the catalyst calendar? What should investors be watching for over the next few months?
The big thing is validating the new strategy. The first major test will be the Q1 2026 earnings report early next year.
What are you looking for in that report?
Any early revenue contribution from the new AI business, any proof that they're putting that $1.15 billion to work, building new capacity, that's what the market wants to see.
What about other market events?
Keep an eye on the December Nasdaq 100 rebalancing. If the stock gets added, that forces all the passive funds and ETFs that track the index to buy shares. it can create a really strong tailwind.
And of course, there's always the rumor mill.
Yes, and with this kind of infrastructure build, the speculation is all about potential partnerships. The market is betting they're close to signing a major cloud provider or a big AI company for that new Texas facility. If that happens, it would be a huge, immediate catalyst.
So when you put it all together, is this a short-term trade or a multi-year hold?
I think it offers something for both. For traders, you have clear, near-term catalysts to play. For long-term investors, this company is sitting at the intersection of two massive trends: digital assets and the power-hungry AI age. It's positioned for years of structural growth.
So to summarize our final thesis, CleanSpark isn't a niche player anymore. It's becoming a dual-engine platform. You have the super profitable Bitcoin mining core, and now this critical diversified entry into the AI compute space. And it's all backed by massive infrastructure and that incredible 0% financing.
The real test, the thing you need to watch, is this. Can they actually make that transition? Can they go from being a commodity producer, which is what a miner is, to being the landlord for high-performance AI? That's the metric to watch. Turning that 43% growth in power capacity into sticky, high-margin AI revenue, that's the whole story for the next few years.
A profound shift to consider. If you found this useful, hit that subscribe button right now and join us for our next analysis.